You know, it's easy to take money for granted. We use it every day, but have you ever really stopped to think where it actually comes from?
It's a great question.
Yeah, so today we're doing one of our deep dives into the whole world of money creation.
Mm.
We've looked at some sources, economic text, analyses of monetary systems, and our mission really is to get a clearer picture.
Yeah, to understand how money's actually made in modern economies,
Yeah.
trying to move beyond maybe some common ideas about it.
Exactly. It might sound a bit complicated, I guess.
It can seem that way.
But stick with us, and we think you'll find some surprising moments, maybe some aha moments.
Definitely. And what's really fascinating here is um, the process isn't maybe as straightforward as you might think.
Right, not just printing presses.
Not just printing presses going brrr. No, it's a more intricate system. You've got key players working together.
Okay.
So to really get a handle on money creation, we need to figure out who these main players are and what they do.
Yeah. Okay, let's unpack this then. Who are these key players in the money creation story?
Well, the first big one is the central bank.
Right, like the Fed here or the Bank of England.
Exactly. Institutions like that, they have this unique power to issue something called reserve deposits.
Reserve deposits. Okay, what are those exactly? Are they like my bank account?
Uh, no, not really. It's important to realize these aren't the funds you or I use.
Okay.
Reserve deposits are primarily held by commercial banks at the central bank.
Ah, I see.
So think about it. When your local bank needs to settle up with another bank, maybe after you've used your debit card somewhere else,
Mm-hmm.
they use these reserve deposits held at the central bank to make the payment. It's essentially like a bank for the banks.
So it's kind of an exclusive club for banks, yeah?
Pretty much. Financial institutions, foreign central banks too sometimes.
Okay. And how do these central banks actually increase the amount of these reserve deposits out there?
Right. They have a few tools. One way is just by making loans directly to the commercial banks that hold accounts with them.
Okay.
Another really significant way is by purchasing assets,
Buying assets. Like what?
often government bonds, but other things too, buying them from those commercial banks.
Okay. And how does buying an asset create reserves?
Well, think about how they pay for it. The central bank just credits the commercial bank's reserve account.
Ah, they just type in the numbers.
Essentially, yes.
Yeah.
So the central bank bought a bond. It's an asset for them now. And to pay, they increase their liability that reserve deposit owed to the commercial bank.
Got it. So money appears in the reserve account.
Exactly. It injects more reserves into the overall banking system.
Okay. So the central bank is working at this high level, dealing with reserves, banks, talking to banks. But what about the money that, we actually use? Our checking accounts, the cash in our wallets, where's that coming from?
Right. And that brings us to the second key player. And this is crucial because this is where the vast majority of the money supply that you and I interact with comes from.
Okay.
Commercial banks.
So my local bank, the big high street banks.
Exactly. Those are the banks where we have our checking and savings accounts. And it's really vital to understand that commercial banks are the primary creators of the money supply, mainly in the form of these, well, commercial bank deposits.
Wait, commercial banks create money?
Yeah.
That still feels a bit counterintuitive. How do they do that?
Well, the main way they create money is simply through the process of issuing loans.
Loans, like mortgages, car loans.
Exactly.
Mm-hmm.
When a commercial bank approves a loan, could be for a house, a car, a business starting up, they don't typically just take money someone else deposited and lend it out.
No, that's what I always thought happened.
It's a common misconception. Instead, they essentially create new money. They do this by crediting the borrower's bank account with the loan amount.
So new digital money just appears in the borrower's account.
Pretty much.
Yeah.
As the Wikipedia page we look at highlights, this process expands the total quantity of bank deposits in the economy.
Wow.
So money creation really happens when the amount of new loans being made is greater than the amount of old loans being repaid or defaulted on.
Okay, this is a really key point then. When my bank gives someone a mortgage, they're not just shuffling existing money around.
No.
They're actually adding new digital funds into the economy.
Precisely that. This ability, this capacity of commercial banks to increase the amount of bank deposits through their lending, that's the main engine of money creation in our economy today.
Okay, so we've got the central bank managing reserves between banks and then commercial banks creating deposit money when they lend. How do these two levels interact? Does the central bank have any say in how much money the commercial banks are creating?
Oh, absolutely. That's where monetary policy comes in.
Right. We hear that term a lot.
You can think of monetary policy as basically the actions the central bank takes to influence how much money and credit is available in the economy and how much it costs.
Okay. And that in turn affects how much money commercial banks create through lending. More formally, it's about how the central bank manages its own balance sheet to influence the conditions banks operate under.
And what's the big picture goal here? What are central banks trying to achieve with this monetary policy stuff?
Usually, they have what's called a dual mandate. They aim for price stability,
Mhm.
so keeping inflation low and predictable, and also promoting maximum sustainable employment.
Okay, makes sense. So if inflation is getting too high,
Right, if prices are rising too fast, the central bank might want to sort of tap the brakes on the growth of the money supply to cool things down.
okay, but how does monetary policy actually do that? How does it influence the bank's lending? It's not like the Fed calls up my bank and says, stop making loans.
No, not directly like that. It's more indirect. So how does it work then if they can't perfectly control the broad money supply? How effective are these policies?
It's a good question. The influence is primarily through affecting the cost and availability of those reserves we talked about earlier.
The ones banks hold at the central bank.
Exactly. By changing things related to reserves, the central bank influences interest rates across the whole economy.
Ah.
And those interest rates affect decisions about investment, about consumer spending, and ultimately the demand for loans.
So what's a key tool they use?
A really key tool is setting the interest rate that the central bank itself pays on those reserve deposits held by the commercial banks.
Right. So if the central bank pays more interest on reserves,
Hmm.
what happens?
Well, that makes it more attractive for banks to just keep reserves parked at the central bank, rather than lending them out or borrowing funds themselves. It can make borrowing more expensive generally, potentially reducing the incentive for banks to lend quite so aggressively.
Okay, that makes sense. And lowering rates.
Lowering interest rates, that's known as monetary easing. It does the opposite, encourages lending, encourages investment.
Right.
The central bank can also expand the money supply, or rather reserves, by buying assets, like we mentioned, quantitative easing is sort of an extreme version of that.
Quantitative easing, QE, right. We heard a lot about that.
Yeah, that's when they do large-scale asset purchases, often government bonds, over a sustained period. Usually when short-term interest rates are already near zero, it aims to push down longer-term rates, too.
And selling assets would tighten things up.
Exactly. Selling assets pulls reserves out of the system, leading to monetary contraction or tightening.
Okay, the central bank is kind of setting the financial weather then.
That's a good way to put it.
Now, when we talk about all the money and sloshing around in the economy, we hear the term money supply. What exactly does that include? Is it just cash?
Good question. The money supply is basically the total amount of safe financial assets that households like yours and businesses
Mm-hmm.
can use easily for payments or hold as, very liquid investments.
Okay.
But it's not just one number. Economists actually categorize it into different levels called monetary aggregates.
Aggregates, like M something.
Exactly. M0, M1, M2 are the most common ones. They're based on how liquid the assets are, how easily you can spend them.
Okay, let's break those down. What's M0?
M0 is the narrowest measure. Think physical currency.
Coins and notes?
Yep. Federal Reserve notes, coins, even old U.S. notes if they're still out there.
Mm.
And crucially, it includes cash both inside bank vaults and out in the public's hands.
Okay, physical cash, then M1.
M1 takes the M0 outside the banking system, so the
Mhm.
cash in your pocket or under the mattress,
Right?
and adds demand deposits. That's mainly your checking accounts. Plus, traveler's checks, if anyone still uses those, and other checkable deposits. Basically stuff you can spend very easily.
Got it. Very liquid. So M1 is ready to spend money. What's M2 then?
M2 is broader. It includes everything in M1.
Okay.
PLUS, things that are slightly less liquid but still pretty easy to access. Think most savings accounts, money market accounts you might have at a bank, retail money market mutual funds, and small time deposits like CDs under a certain amount.
So stuff you could turn into spending money relatively quickly, but maybe not instantly like cash or checking?
Exactly. Understanding these different types, it kind of leads naturally into thinking about how money itself has changed, right? From physical stuff to, well, mostly digital now.
Yeah, that's a good point. The sources mention the gold standard and then fiat money. Can you give us the quick version of that shift?
Sure. Historically, many currencies were linked or backed by a physical commodity, usually gold. That was the gold standard.
Right. The idea was the money was worth a certain amount of gold.
Precisely. It was meant to give it stable intrinsic value. But that system, particularly the post-WWII Bretton Woods system where the U.S. dollar was tied to gold, eventually broke down. Nixon ended the dollar's convertibility in 1971.
Okay.
And since then, most major currencies operate as fiat money.
Fiat. What does that mean exactly?
It means its value isn't based on gold or silver or anything physical. It's based purely on, well, trust and mutual agreement, faith in the government and central bank issuing it.
So it's money because we all agree it's money.
Essentially, yes.
Yeah.
And law is saying it's legal tender, of course.
And with physical currency, you always have the problem of counterfeiting, I guess.
Oh, absolutely. Governments and central banks put a lot of effort into security features on notes and coins to make them hard to fake.
Yeah, the little strips and watermarks and stuff.
Right. And sometimes currencies get demonetized too, meaning they're declared no longer legal tender. Maybe there's a currency reform,
Yeah.
or they want to flush out illicitly held cash. The central bank manages that whole life cycle of physical cash.
So thinking about M0, M1, M2, all that digital money in M1 and M2, how much does actual physical cash, M0, matter in the grand scheme of things today?
It's surprisingly small, actually.
Yeah.
Physical currency is just a small fraction of the broad money supply in most modern economies.
Really? Like how small?
Well, the source mentioned the UK, where total bank deposits are something like 30 times the amount of physical currency out there.
30 times. Wow.
Even in the US, the ratio is significant, maybe around 8 to 1 or so, depending on exactly how you measure.
So most of our money isn't paper or metal, it's just numbers and computers.
Overwhelmingly, yes. It exists as digital commercial bank deposits, which really underscores that point about commercial banks creating money through lending.
Yeah, that fact that most money is bank deposits created by lending. It does make you think about who controls the flow of capital, doesn't it? And if that matches up with what society needs.
It raises some big questions, for sure.
Okay, moving on. The research mentioned something called debt monetization. What does that term mean? Sounds a bit ominous.
Uh-huh. Well, it can be controversial. Debt monetization basically means the central bank creates new money specifically to finance government spending. Like the government spends, and the central bank prints the money to cover it, directly or indirectly.
So the government is spending money it doesn't have from taxes, and the central bank just creates it.
That's the essence of it, yes. It's direct monetary financing of fiscal deficits.
Was that always frowned upon?
Historically, yes, especially under fixed exchange rates like the gold standard. There were often legal bans on central banks directly funding the government.
Why? What was the worry?
The big worry was inflation. If the government could just get the central bank to print money whenever it wanted, it could lead to excessive money creation, hyperinflation, and destroy the currency's value and the exchange rate peg.
Right. But the sources seem to suggest the relationship today is a bit more complicated.
It is. In modern systems, central banks and governments, the fiscal authorities tend to work together much more closely. They coordinate to manage the economy, interest rates, financial stability.
So maybe not direct printing press financing, but still close cooperation.
Exactly. The central bank often manages its operations, like buying bonds, in ways that effectively help the government manage its debt smoothly, even if direct financing is technically forbidden.
Are there examples of how this differs between places?
Sure. The Eurozone is quite strict. Article 123 of their treaty explicitly forbids the European Central Bank, the ECB, from directly buying debt from member governments.
A clear line there.
Yes. But then you look at Japan. The Bank of Japan has, for years, bought huge amounts of Japanese government bonds. Some would argue it's effectively monetizing a large chunk of the government's debt.
Okay, so different approaches. What about the U.S.?
In the U.S., the original Federal Reserve Act allowed some direct purchases, but the Banking Act of 1935 mostly stopped that. The Fed was pushed towards operating in the open market, buying and selling bonds that have already been issued.
Secondary market stuff.
Right. There was a temporary exception during World War II, a direct line of credit. But today, the Treasury issues debt. It's bought initially by primary dealers, and then the Fed buys or sells those securities in the open market to influence reserves and interest rates. They ensure the whole system settles smoothly.
So even if direct monetization is restricted, there's still this significant interplay in managing government debt and the overall amount of money and credit.
Definitely.
You mentioned open market operations there. We hear that phrase all the time when the Fed makes announcements. What exactly are they doing?
Right. Open market operations, or HOMOs, are the bread and butter tool for central banks implementing monetary policy day to day.
Okay.
It simply means the central bank buying or selling assets, usually government securities, in the open financial market.
And what happens like instantly when the central bank buys assets through FOMOs?
Okay, so the central bank decides to buy, say, $1 billion worth of treasury bonds. They'll typically buy them from commercial banks or dealers.
Right.
To pay for those bonds, the central bank simply credits the reserve account of the bank they bought them from.
The reserve account held at the central bank.
Exactly. So, boom, $1 billion in new reserves just appeared in the banking system.
Okay. Injecting liquidity. Our research mentioned the Fed's trading desk in New York.
Yeah, the open market trading desk at the New York Fed is the operational arm. They conduct these transactions usually with a group of large financial institutions called primary dealers.
I see.
When the desk buys securities from a dealer, the Fed credits the reserve account of that dealer's main commercial bank.
Yeah.
Reserves go up.
And the reverse happens if they sell. If the Fed sells bonds.
Precisely. If the Fed sells bonds, the buyers, usually banks or dealers, pay for them. The Fed debits their reserve accounts, so reserves drain out of the banking system.
Okay.
They also use things like short-term repos, repurchase agreements.
Repos.
Yeah, it's like a very short-term loan collateralized by securities. The Fed might buy securities with an agreement to sell them back the next day or vice versa. It's a way to fine-tune the amount of reserves day to day and keep short-term interest rates, like the federal funds rate, near their target.
So these operations manage things short term, but also serve longer goals.
Absolutely. They manage daily liquidity, keep the target interest rate stable, but also implement the broader stance of monetary policy, easing or tightening, aiming for those longer-term goals like stable prices and employment.
Got it. Now, for a long time, there was this idea of the money multiplier used to explain how central bank actions, like changing reserves, affected the total money supply. But our sources say that idea is, well, not really the main story anymore.
Yeah, the money multiplier theory was standard textbook stuff for decades.
Right, I remember learning about it.
It basically said the total money supply, like M1 or M2, was a stable multiple of the central bank's monetary base, which is reserves plus currency.
Okay.
And the size of that multiplier was supposedly determined by the reserve requirement ratio, the percentage of deposits banks had to hold in reserve.
So the idea was the central bank injects $1 of reserves and banks lend it out multiple times, creating $10 or whatever of deposits.
That was the basic idea, yeah. A mechanical linkage.
But why isn't that seen as the primary explanation now?
Well, there are a few big reasons. First, many major economies, the US, UK, Canada, Australia, New Zealand, don't even have reserve requirements anymore, or they're set effectively at zero.
Oh. Well, that kind of breaks the multiplier mechanism, doesn't it?
It certainly removes that direct link. Second, and perhaps more importantly, practical experience, especially after the 2008 crisis when central banks flooded the system with reserves via QE, showed that banks don't just automatically lend out every dollar of excess reserves they get.
They just sat on them sometimes.
Sometimes, yes.
Yeah.
Their lending decisions are driven much more by other factors.
Like what?
Like, is there demand from borrowers who are actually creditworthy? What's the state of the economy? What are their own capital levels like? Regulatory requirements like Basel III capital ratios are a much bigger constraint now than reserve requirements ever were.
Okay, so if the money multiplier isn't the main driver, what's the current thinking on how commercial banks actually expand the money supply? Back to the lending thing.
Exactly. The dominant view now, among central banks and most economists, is that commercial banks create new deposits when they decide to make a loan.
The loan creates the deposit.
Yes. The act of lending creates money. It's not constrained, in the first instance, by how many reserves they have parked at the central bank.
So they lend first and worry about reserves later.
Sort of. They make the loan based on whether it's a good prospect, profitable, meets their risk criteria. Then they ensure they have the reserves needed for settlement purposes or to meet any, often minimal, regulatory requirements afterwards. They can borrow reserves from other banks or from the central bank if needed.
So the banking system as a whole can create a lot more money than the initial reserves provided by the central bank.
Far more, potentially.
Right.
The old model kind of implied the central bank was driving the bus very directly.
Right.
The current understanding gives commercial banks a much more active endogenous role in money creation through their lending choices.
Okay. And you mentioned capital ratios like Basel III being a constraint. How does that work?
Right. Banks need to hold a certain amount of capital, basically, their own equity and retained earnings relative to their risk-weighted assets, which includes loans.
Okay.
So making more loans increases their assets, which means they need more capital to stay above the required ratio. That acts as a brake on unlimited lending. But it's about capital adequacy, not about a direct multiplication of central bank reserves.
So the limit is more about the bank's own financial health and risk management, and crucially, whether people actually want to borrow.
Precisely. The demand for loans from credit-worthy borrowers is now seen as a primary factor limiting the amount of money creation.
This really shifts the perspective on control, doesn't it? If central banks directly control reserves and cash, but commercial banks create most of the deposit money through lending, how much control does the central bank really have over those broader M1, M2 measures?
That is a really central and debated question in monetary economics.
Yeah, I bet.
While they absolutely control the monetary base, their influence over M1, M2, the broader money supply, is definitely more indirect and, frankly, less precise than the old multiplier stories suggested.
So that's why the sources say central banks don't really use the multiplier for policy guidance anymore.
Exactly. The link just isn't stable or predictable enough in practice. Economists like Benjamin Friedman have pointed out the multiplier is a simplification that ignores how interest rates affect the demand for reserves versus deposits. David Romer also noted the practical difficulties central banks have in actually hitting targets for broad money aggregates if they try.
It sounds like they tried targeting the money supply directly at some point.
They did. Back in the 70s and 80s, the era of monetarism associated with Milton Friedman,
Right?
some central banks, including the Fed and the Bank of England for periods, tried to control inflation by setting targets for the growth rate of M1 or M2.
And how did that work out?
Not brilliantly, to be honest. They found it really hard to reliably control the aggregates month to month. And the relationship between those aggregates and inflation or economic growth started breaking down what economists call velocity instability.
So they gave up on it.
Largely, yes. By the 90s, most major central banks had shifted their operational focus away from targeting money supply growth and towards targeting a key short-term interest rate instead.
Like the federal funds rate in the U.S.
Exactly. The idea is, by setting that key short-term rate, they influence borrowing costs throughout the economy. That affects the demand for loans, investment spending, and indirectly influences the pace of money creation by commercial banks. But they don't pretend they can dial in an exact M2 number anymore.
So influence, not direct control.
That's the key takeaway.
Okay, this leads nicely into the last main idea from our sources, the credit theory of money. Sounds like a more modern take.
It is, although it has roots going back quite a way. People like Schumpeter talked about it. But yes, it's a perspective that really emphasizes the role of banks, commercial banks, as the active creators and allocators of the money supply.
It's putting banks front and center.
Right. It sees money primarily as credit. When a bank makes a loan, it's creating credit, which functions as money.
Okay.
This theory also often distinguishes between what it calls productive credit creation loans that finance, say, new investment, technological improvements, things that expand the economy's productive capacity without necessarily causing inflation, and unproductive credit creation, maybe loans for purely speculative asset purchases, or just funding consumption without boosting output. That kind is seen as more likely to fuel inflation or asset bubbles.
Interesting distinction. And how does this view square with the idea that central bank reserves drive lending?
Well, the credit theory, along with a lot of modern neo-Keynesian and especially post-Keynesian thinking, and frankly, how many central bankers describe the process, it rejects that old reserves first model.
The idea that banks need reserves before they can lend.
Exactly.
Yeah.
The credit view says banks don't passively wait for reserves or deposits to come in before lending. They are actively seeking out lending opportunities.
Based on?
Based on the borrower's creditworthiness, the prospects for the loan being repaid with interest, the general economic climate, standard banking criteria.
Okay.
If they find a good lending opportunity, they make the loan. And in doing so, they create a corresponding deposit in the borrower's account. Then, they manage their reserve position afterwards to meet any requirements or handle payment settlements.
So lending decisions come first.
Lending decisions drive deposit creation, which means the primary limit on how much money is created isn't the amount of reserves the central bank supplies, but the demand for loans from borrowers that banks deem creditworthy and the bank's willingness to lend based on capital constraints and risk assessment.
That really flips the old model on its head.
It does. It suggests money supply is largely endogenous, determined from within the private banking system by lending activity rather than exogenous, directly controlled from outside by the central bank.
Wow. Okay, that's a lot to digest. So let's try and recap the main points here. Money creation in our modern world is really a two-level process, right?
That's a good way to think about it.
You've got the central bank creating the base layer reserves for banks and physical cash.
Right, the monetary base.
But then, much more significantly, for the money most of us actually use day to day,
Yes,
it's the commercial banks creating deposit money when they make loans.
that's the core mechanism, yes.
Yes.
Lending creates deposits.
And that old money multiplier idea where reserves get mechanically multiplied into loans, that's, well, it's not really how it works in practice anymore, especially with no reserve requirements in many places.
No, it's largely been superseded. Constraints like capital adequacy and, crucially, the demand for creditworthy loans are much more important.
So the demand for loans really plays a huge role in how much money is circulating.
A very significant role, yeah.
Okay, that's a really different picture than maybe many of us had. So thinking about this, if money is mostly created by banks when they lend, what does that imply, for things like economic growth or financial stability? And what does it mean for regulating the banks?
Those are exactly the right questions to be asking. It opens up huge discussions about the role of credit allocation, the potential for booms and busts driven by lending cycles, and how regulation should best manage that process for the public good.
Definitely things to think about. Well, thank you. This has been incredibly illuminating, untangling this complex topic.
My pleasure. It's a fundamental aspect of our economy that's often misunderstood.
Absolutely. We really hope this deep dive has given you, our listener, a clearer, maybe more nuanced perspective on where money really comes from.
Hopefully some aha
Yeah.
moments in there.
Yeah. So now it's kind of over to you to mull this over. What are your takeaways? What other questions does this raise for you about our whole financial system, about banks, about central banks?
There's always more to learn.
For sure. We definitely encourage you to maybe dig deeper into monetary policy, banking regulation, even the history of economic thought around money. It's fascinating stuff. But for now, that's all for this deep dive. Until next time.